Hello, everybody. This is Gavin Maguire. You might know me better on the website as Event Trader. Just want to say a happy 2017 to all of you guys and gals out there. And with the start to the 2017, what we wanted to do is kind of run a webinar just looking at some of the key themes and dates that are going to be taking place in this year. The title of it, of course, is 2017 Outlook. Playing the markets as the markets play politics. Politics will once again be at the center of a lot of the themes that we are looking at. So getting underway here, basically looking at the key themes in 2017. Obviously, we have Trumponomics. How will it be defined? Taxes. What is the plan going to be here? Fiscal stimulus. Will it pass, and where will the money go? Trade. How will it reshape globalization? And geopolitics? What can change? We're going to focus on the domestic first, as that's probably going to, have the biggest impact on your guys' portfolios and provide the most trading ideas. One quick side note before we get into this: if anybody's got any questions, please feel free to put it into the chat room. We will address them at the end of the or at the end of the webinar, as long as there's time permitted. Otherwise, I'll address them on the website. But taking a look at Trump's platform. So basically, he was looking to lower taxes, provide fiscal stimulus, cut regulation, renegotiate some of the trading deals, and, of course, repeal and replace the Affordable Care Act. I've provided some dates on the outlooks for when some of these items could become more in play or, more immediate, if you will. The lowering the taxes, that's expected to be one of the first obstacles for the Trump administration to address. Fiscal stimulus is likely to come more towards the middle of the year as we start discussing some of the budget parameters of 2018. Deregulation, we should see some immediate action on that. Renegotiating the trade deals, that's not expected until later. They're going to address some of the other issues first. And then, of course, the repeal and replace the Affordable Care Act. It's under immediate debate, obviously. Legislation is not expected until 2018, but the recent rhetoric suggests that this could come into place faster than was expected. I know I was certainly not expecting any sort of a replacement, some repealing in some areas, but that's showing some signs of possibly heating up a lot quicker than anybody expected. First, we've got to take a look at the makeup of Congress as we approach this new year. The Senate, after the Louisiana runoff, holds a 52-48 advantage for the Republicans. Now, this is going to be the key area because there are a couple of possible swings. There are three Democratic senators or Republican senators that are coming from states that Trump lost. But the Democrats are facing a pretty tough 2018 midterm, where they have 12 seats up for grabs. So that's one of the dynamics that is going to be facing this Congress. We also put out some of the Republicans and the Democrat names to watch that could really hold some sway. We're already seeing Rand Paul with his health care comments from yesterday working his way into the news headlines there. And a lot of these players that I've just noted here, we're going to go into a little bit more detail down the road. But there's a few names to keep on the watch that could be key swing votes that will prevent or push legislation through. On the House side, the Republicans hold a pretty healthy 241 to 194 advantage, which is approximately 55% of the House. So that's not really seen as being much of an issue. Most of the areas are going to be played out in the Senate. All right, taxes is going to be a first look for the administration. They have not released the full details, but we're going to go through some of the different areas. Capital gains taxes will be one area where we're expecting to see some cuts to it. We're going to provide some numbers on the site for you to break down some of the differences, but there hasn't been a lot of detail released on that. One low-hanging fruit here is the 3.8% surcharge for the ACA. A repeal of this is likely, as we're going to start seeing the House or the GOP slowly kind of peck away at different ways of funding Obamacare in its attempts to change the law. in the election webinar, we kind of discussed some of this, and we noted that the likely reaction from Trump win would be a delay in selling to capture lower rates, as well as some momentum names benefiting. And we have seen that. You can't find a seller anywhere these days, and that's likely to continue on as we move forward, at least in the first part of the year, until we get a better idea of where these capital gains taxes are going to end up. Income taxes. Big talk here is reducing the tax brands from 7 to 3, with 12%, 25%, and 33% being the areas of income taxes. A lot of the early studies have shown that the general belief is that this is going to benefit the higher end of the income scale, which just has been noting a few of the higher end retailers. This is just a simple way of looking at it, but some names that were jumping off. I already had mentioned the JWN on the site and took a long on that. But, Coors, Coach, and Kate Spade are just a couple of names that I'm going to be looking at. And I'm going to kind of expand on some of the retail areas when it comes to corporate taxes shortly here. Plans on standard and itemized deductions have not been final. This is going to be a key area to watch. Items like mortgage deductions, seeing if there's any changes here. But this is all going to be in play. Some of the laws are expected to be passed in early 2017. Again, a low-hanging fruit for the administration to come in, as there will be broad support in the GOP to quickly pass this through Senate and the House. There'll certainly be questions on making it revenue neutral, but I think this is the area where we're going to see the most inroads made early. Corporate taxes. This is going to be a hot topic, and we're going to really see a lot of this discussed in Q4 earnings conference calls, and that's going to be one of our primary focuses on the site. Trump's called for 15%, for a reduction of 15%. We've seen Ryan call for a 20%, or reduction of 20%. Obama himself argued for a reduction of 27%. The current rate, as we can see, is 35%, with the effective tax rate, that's after all the deductions and everything, at approximately 26.6%. We're expecting to see something fall in the range of 15 to 25%, obviously 15 being the high end, 25 being the low end, but deductions can play a role into this. There's also, of course, the destination tax, or, as we know in other countries, the VAT tax, for the value-added tax, and the border tax, which has been a hot topic as of late with, the tweets from Trump that we've seen. Also, the one-time repatriation tax is another hot topic, where there's been talks of 10% of earnings and also deferral of taxes on foreign holdings, allowing people to bring money back overseas. Apple and Google are naturally the ones most discussed here, since they have a pretty hefty overseas cash. Apple, $260 billion, Google at $49.7 billion, if you're curious. One hot topic, too, Ryan has suggested the elimination of deductions on net interest costs. This could be pretty big for companies that aren't leveraged, and I'm highlighting Disney right here as a play. We've seen it run up on the Rogue One commentary, as well as some technical breakthroughs of some key moving averages. But I think the potential of the elimination of this net interest cost tax would be big for Disney and really be a boost for it. And I think that's one of the reasons why we've seen Disney rally here early. Again, possible early 2017. With regards to the earnings conference calls, I did want to highlight the Constellation STZ is the ticker conference, where they did some good color on that. I'm going to post it to the site, so you could see some of the commentary from, you could go onto the NASDAQ page and go check out the transcripts, do a keyword search for tax if curious to see the full thing. But basically, it was just kind of discussing some of the plans that the company had, as they have a lot of their operations in Mexico and Canada from their whiskey and their tequila business, and some of the discussions that they had. And they've been in close contact with a lot of people in Congress, and I thought it was notable that they said that Congress is really kind of still in the dark on what they plan on preparing for this. So, we say early 2017, but this could be pushed back into mid-2017 as well. But the potential for companies to be moving overseas operations back here is obviously the hot topic here, as we've been seeing with a lot of the auto companies and Constellation in itself from their commentaries. Continuing on the corporate taxes, this is kind of why I was highlighting some of those retailer plays. Obviously, it's been an ugly early season for the bricks and mortars with the Macy's and Kohl's guidance. But these are two areas that should really benefit from the corporate taxes, as specialty retail has a 37% tax rate and multi-line has a 34.3% tax rate, two of the highest areas in the markets at the moment. Consumer discretionary has got the second highest rate in the S&P at 31.4%, and I've highlighted a couple of plays down here that could benefit from tax reduction. Restaurants is another area, with Chipotle, CMG, being a particularly interesting stock given today's action, as the December comps really showed some improvement. So that's going to be a name I'm going to be focusing on earlier. One real quick question I see, can we get a copy of the PowerPoint presentation? I will be providing this on the site. If anybody's having issues seeing this, please let me know, but this will be provided on the site, as well as Q&A. But moving along, the next area we're going to take a quick look at after the taxes is infrastructure. Trump, of course, proposed a spending infrastructure of $1 trillion while reducing taxes, which leaves the spending gap to be largely financed through Treasury debt. This is going to be a key issue, especially in Congress, as you know, we obviously have a lot of fiscal hawks. Think of the battles that Obama had with the debt ceiling trying to be raised. So currently, the discussions on how this is, obviously the idea is that growth will fill that gap, but it's going to be interesting to see how some congressional members respond to this, especially on the GOP side, such as Rand Paul, that has been a stickler for managing the budget. And some of these methods could really increase on the dollar and on bonds moving forward. So right now, that's not the lead for the impact on bonds and the dollar. That's obviously rates from the central bank. But, this is an area where we're going to need to watch down the road in terms of how it is going to be funded. Now, obviously, these actions will steepen the yield curves, and we're really seeing the boost in the financials in that area, and that's really going to be a hot topic. Obviously, we got J.P. Morgan, we got Wells Fargo, and we got Bank of America, just to name a few, reporting earnings on Friday. I'll be doing the earnings previews for this and listening to the conference calls. So I'm going to be really commenting a lot on, what we're seeing, what the banks are seeing, what their ideas are. Have we gotten too far ahead of ourselves at the moment? With regards to the infrastructure plan, most reports that I've been seeing have put the boost to the GDP at 0.50 to 0.75%. This will be up for argument amongst economists, but if you're looking for a general idea on what kind of boost we could see from that, at the moment it's not a lot. And some of that can be attributed to the fact that people simply don't know what the plan is. The others could be attributed to most fiscal stimulus has a bigger impact when you're in a recession. We currently are in a growth mode, and so the impact could be a little bit more limited. And we've been seeing that with commentary from the Fed Chair Janet Yellen, and just in an op-ed in the Financial Times, I thought very notably, was San Francisco Fed President John Williams, who obviously is thought of to have a pretty close discussion with the current Fed Chair. They both discussed how it needs to be purposefully directed, and that it might not be a big boost to the current employment, which we are currently nearing full employment. And some of the impacts on inflation could be negative, as we'll discuss in some of these later slides. But I think there is some bipartisan support, which is a bonus, and there could be some low-hanging fruit here in the highway and airport infrastructure rebuilding. So obviously some of the early looks that we're watching is the heavy manufacturing materials companies, which we kind of discussed in the election webinar. That would have been a positive for both Hillary or Donald. So we've kind of see a run up in those areas, but that's going to be what we want to continue to watch. The big names obviously are Cummins, Caterpillar, and Deere. CEMEX is one that I have on my 2017 plays, which is, of course, a Mexico play. It's a little bit trickier, a little bit of holding your nose on that. But they got a lot of U.S. operations, and again, I think some of these tariffs are going to be pushed back, and I think CX is one that will see benefits from a building. I don't know what's going to go on with the wall, but infrastructure plays on the highways and stuff. I think it's going to be a big winner here. So that's the name that I'll be discussing a lot. I already have along on the site, and I'll be talking about it more as we move along. Okay, so taking a look at trade. So Trump used this as a battle cry, in terms of returning jobs and everything. There's been debates on why we're losing the jobs, but we're certainly going to have his theories put to the test here. I'm kind of interested to see how that does work out personally. He's talked about renegotiating NAFTA and canceling the TPP, which seemed to be kind of off the table anyway. So what's going to take place of those will be of particular interest. And, of course, the president-elect continues to show a hard stance on China, and we've really seen that with some of his nominations in key trading areas. So one of the things from free trade that it has been a bonus is it's increased competition and lowered prices. Think of manufacturing set up in other areas. So that's going to really be the what we want to watch moving forward. Is how's this going to impact supply lines for companies, particularly in the tech industry. A move away from some of these free trades could prove a further inflationary bug for the Fed. So bonds and gold we're going to be taking a look at. With the reflation trade, we've been seeing a bounce in gold as of late, and of course the yields and bonds have been running, but I think that's simply more a play on the reserve rates. For gold, I kind of see it as an empty bounce at the moment. Everything's pointing towards buying gold, but it still seems to be having some tough times getting a leg up here. Whether or not this is a false V-shaped bounce or an actual V-shaped bounce will be one of the more interesting stories in early 2017. When you look at trade, you got to look at our largest trading partners, and of course that falls to China, Canada, and Mexico, which makes up approximately 45% of U.S. exports and imports. When you're looking at the macro of it, you got to look at the number for the S&P, and that's 30% of S&P revenues are generated overseas. So, when you're trying to take into the entire impact of what this could be, these are some of the numbers you want to look at. Now, House Speaker Ryan has already said that he's not looking to run a tariff through Congress anytime soon, and this has further been supported by Wilbur Ross, who provided a similar commentary with regards to trade deals, that he's not looking to press forward anything in the near future. And I think this is important because I do think that the president-elect will rely heavily on Mr. Ross for his input into this. Now, one of the key aspects is how quickly can these tariffs be put into place. And I wanted to point out, going back and looking through similarities from past presidents, really this has been going on for a long time, where presidents, Article 1, Section 7 in the Constitution basically lays out the laws for it, and that's for trade rules to be going through Congress. However, Article 1, Section 8 lays out presidential emergency actions that can be taken unilaterally in order to put tariffs in place. So President-elect Trump does have a lot of power here, and that needs to be noted. It goes back all the way to the Civil War, when Lincoln used this article and section in order to put a 4% tariff on exports on Southern cotton. And it's also been used by FDR during World War II for imports as well. I'm going from the Nixon trade emergencies that were put into place back in the early 70s, as I think they're the most relevant, in which President Nixon put a 10% surcharge on imports, also on licensed oil imports, and did a deal to restrain steel imports as well. So all these were able to pass, and all of them had an impact on the companies involved. And basically what he was able to do was implement an emergency strategy. Now, this doesn't need to be anything that we're seeing or that's impacted us. This could be something that could be viewed as retroactive. So when you get the idea that manufacturing jobs, about 2 million have left the U.S. over the last 10 years or so, this could be looked at post-mortem, basically, and viewed as an emergency, and thus allow President-elect Trump to move. So these tariffs can be put in place pretty quickly, and that's going to be something to keep in mind. So when you do see these tweets going out, they need to be respected, because they can also, it just kind of is something that could be in play sooner rather than later. Okay, continuing with the trade. Some of the areas that we're going to have to watch here. Aerospace is the largest export industry. Gross exports of $119 billion in 2015. Asia Pacific makes up a third of global travel, and 13% of our exports goes to China. We've also been seeing, the Boeing tweets. So, this is a key area to watch. Auto, we've already been seeing plenty of that in the news with Ford and General Motors. Auto is, we discussed it in the election webinar, and that was one key space because the supply chains are so diversified in different regions that they could easily be the most impacted by any trade changes to the trade deal. So the stocks have been holding up pretty well as sales have continued to, I know the December numbers were just recently released last week, and the industry is doing extremely well. But that's an area where I'd be looking to get short in 2017 in case we see a pullback from some consumer spending, and we also see some of these tariffs be discussed about a little bit more aggressively. Now, this is for U.S. oil imports. And, approximately 33% of the oil imports are coming from Canada and 14 billion from Mexico. And then our exports going back to them are a little bit smaller. But these are going to be some key areas to watch also in, any NAFTA renegotiations. With regards to throwing tariffs on companies, the chemical industry is going to be one that I'm going to be watching closely, because this is one area that could be closely targeted by China is if we decide to see a tit-for-tat type of trade war going on. Technology is another area, as a lot of the supply chain comes from overseas, as we discussed, and I provided some of the names that have a lot of revenues in Asia, in the Asian markets here. So now we're going to move on to the Healthcare Act, which has really picked up in recent time. The repeal of the ACA and the replace with the market-based system has been named as a top priority by the GOP. To be honest, I was expecting some small repeals to kind of kick off 2017, but a replacement to be pushed back until 2018. It really looks like the GOP is looking to come up with something a lot quicker, and that's going to be something that's going to really shake these markets a lot. And it's going to cause a slowdown in spending in a lot of areas. Now, there's a budget resolution due for January 27th. This could be the first area where the ACA is attacked. I'm expecting to see this pushed back until March, but that's probably going to be one of the first key dates, and it's going to happen right ahead of the Fed meeting. So that's going to be one area that we're going to want to watch, because a lot of the first moves that the GOP is going to make for repealing this is going to be defunding it. And to be able to do that, they're going to be doing that through legislation. That's going to be really tough for the Democrats to suppress or block. So some of the key things that we're going to look for under Trump is the removal of barriers on interstate insurance, the allowance of purchase of high-deductible healthcare savings plans, deductibles on insurance premiums for personal income tax. They're going to be some of the areas that they're going to attack and really have an impact on healthcare providers and insurers, which we'll be discussing shortly. Moving on, the FDA user fee authorization. This is another date I wanted to point out to you. This is related to pharma and medical devices. This must be reauthorized by September 30. This is another area. This is just kind of an example of stuff that the Trump administration can let go and just not renew. And these will be fees that are lost for the pharma and medical devices. One thing to point out, though, is Trump's not really shown an interest in a lot of the details. He's basically been talking big picture, kind of like with Wilbur Ross in the trades. So we're going to want to be paying close attention to Tom Price, who was named Secretary of the HHS, and will really have his be one of the architects for the replacement of Obamacare. And to keep that in mind, some of the things that Price likes is tax credits to buy insurance, special federally controlled or state-run risk pools established. So these are just some of the topics that you're going to see a lot of in the news. And comments from the healthcare providers, pharma, and medical devices during earnings calls are going to be key to listen to. So just taking a look, what can get done? As we discussed, full repeal is pretty easy. All Congress has to do is stop the funding. If the money's not there for the subsidies or the refundable tax credits, Obamacare simply can't run. One thing that I wanted to point out here is the House versus Burrell, which is a recent ruling. Basically, the House sued President Obama, saying that the bill wasn't being properly appropriated, or funds for the bill was not being properly appropriated, and they challenged the cost to sharing reductions, with lower deductibles and copay. They won this case. This is the first time the House has ever won a lawsuit against a president. So right there is notable in its precedent. I'd look for Trump to just kind of go along and repeal this pretty quickly, because I don't think that's a precedent that he's going to want in place when he's the president. But that's going to be another headline to watch here. Now, replacement's a little tougher, as bipartisan support is going to need 60 votes to avoid a filibuster. We kind of already saw Obamacare. One of the biggest failures for that, in terms of my opinion anyway, was that it wasn't a bipartisan bill, and it kind of really wedged in a divide in the early goings that President Obama was just never really able to get back over. So if they're looking for a replacement, they're really going to have to find something that's going to be able to go across both areas. So I just really think that the replacement's going to be a lot tougher than the repeal here. When you're looking again at the replacement, some of the low-hanging fruit is the Cadillac tax. Look for that to be removed. Deeply unpopular with the unions, so both sides are going to want to see that dropped. Elimination of the cost-sharing subsidies, as we discussed. An allowance for insurance companies to cross state, which in theory should lower some of the costs for insurance, and also a cap on multi-practice lawsuits, which is basically just to say doctors will be a little safer against the potential for malpractice suits. Look for these items to get taken care of pretty quickly. Now, for the rescinding of the individual mandate, the tax penalties, as well as tax credits instead of subsidies for those who can afford. This is more of the replacing, and this is going to be a little tougher to do. Also, for the insurers to cover preconditions, looking for a removal of that. Again, that could be a little bit sticky of a situation. But perhaps the most difficult aspect of this is the human aspect of it, and that's 22 million people have signed up under ACA. Personally, I think it's political suicide just to throw them out without any sort of coverage. It's also going to really kill some of the bad debt expense that some of these hospitals are looking at. So there's going to have to be a plan for changing those people that signed up under Obamacare and extending the coverage. That's going to be a really interesting aspect, and one I don't see the Republicans really addressing ahead of the midterms, because it's simply votes that they're just not going to want to lose. Moving on to insurers, there's going to be a lot of volatility in the insurers. They incurred the most losses from the ACA, and we pointed that out in the election webinar as an area for potential rally, and they have been one of the stronger groups since the elections. If cost sharing is repealed, though, you could see a lot of these insurers leave the markets. The idea is they're not going to want to get caught holding the bag for a lot of these insurance claims if there's no cost sharing. And at present, the government's is supposed to take up that with the Obamacare fees, but if that's eliminated, then all of a sudden there's a big black hole that the insurance companies aren't going to be caught on the cost for. And again, this goes to the bad debt expense for a lot of the hospitals. So the GOP prefers keeping requirements for insurance to cover pre-existing conditions. So that's going to be another topic to watch. Now, we discussed this in the election webinar as well. Under repeal, insurers could see a flood of members seeking health care before terminated. Going to be real interested to see a lot of these insurers in the Q4 earnings theme to see if they just saw people piling in and getting medical procedures done with the fear that that would not be available to them under a Trump administration. So really curious to see how these costs rose for these insurance companies in Q4. And I think it could really weigh on some of the results. So some of these gains that we saw in the insurance companies, I would not be surprised to see given up on poor Q4 earnings. The healthcare service providers. One of the big winners has, of course, been the acute HCPs. Because the reduction of bad debt expense was really big for them. We could see a pickup in that as we move away, and especially if some of the 22 million that we've discussed are moved off the Obamacare subsidiaries. So a change to the Medicaid block grant would be negative for the providers too, and that's kind of what the Trump administration has discussed, especially nursing names. So it's going to be an area we're going to want to watch. However, I don't see any of this happening in the next 12 months. So I do think these names are safe, but again, an area that's going to be hot that we're going to discuss a little bit further on the site as we move along too. There's just simply too many moving parts of the healthcare area to address in this webinar alone. Medical devices, they should be impacted on a negative basis on the ACA. It's not completely clear, but one has to figure that the revenue stream for a lot of their providers is going to be hurt, which obviously will hurt some of, orders for some of the devices. We're already seeing a slowdown in spending given the uncertainty. So again, I'm looking for some weak guidance out of this area as we move along in the next couple of weeks. And then the Consolidated Appropriation Act, it's got a 2-year moratorium on medical devices. That's an excise tax at 2.3%. Part of the funding for the ACA, again, a low-hanging fruit for the GOP to remove. And I discussed earlier on the capital gains tax, the 3.8% medical tax that you should see leaving as well. So this is an area where I think it's going to have a rough start to the first half of the year. Moving on to the pharma, a beaten down area, but I kind of like this area at the moment. I've been talking about Teva and VRX on the website. VRX is a January effect play. But the pharma industry has been brutalized by the ACA with higher industry fees, high rebates for Medicaid beneficiaries, and the discount for Medicare Part D plans. Trump has discussed, one quick side note, Trump has discussed removing barriers to import drugs from foreign companies that can be produced at lower cost too. So, I know that there's the Trump tweets, but I think rather than going through that and aggressively attacking these companies, I think that they're looking really for a more market-based system that's going to allow for more competition in this. So that's another reason kind of why I like Teva, a foreign-born company, Israel-based, that could move in with their generic drugs and really see some growth in the U.S. And going back to the Trump tweet on high drug prices, I just wanted to note that the Takeda acquisition of Ariad Pharmaceuticals that was done over the weekend, this is kind of a toe step into the area of pharma pricing, and one that suggests to me that some of these pharma companies think that a lot of the headline news on this area has already been beaten. I don't think that 2017 is going to be completely void of this, but I do see it to be a little bit healthier of an environment for the pharma companies and pricing. Just to point out, there's 20 new drug approvals in 2016. There was 45 in 2015. The new administration is expected to be more accommodative for this. I apologize for the typo there. So I think that could really benefit the pharma companies. I've listed a number of the names that I'm going to be taking a look at. Teva, VRX, and Guild, though, are the ones that I've been watching closely and the names that I like here. Okay, moving on to regulation, or should we say deregulation in this. Changes are likely to come in the way of riders on key legislation. Financials have obviously seen a big boost from this. We currently have approximately 70% of the Dodd-Frank rolled out, and 9% has been implemented and rules published. 20% is yet to be proposed. I think it's safe to say that the 30% that hasn't even been put into place will not go in. And then there's the question of the 70% of Dodd-Frank, what will be repealed. We really haven't heard of a lot of details on this, but I'm expecting, obviously, the big money center plays like a Goldman Sachs or Morgan Stanley to be one of the bigger beneficiaries from this. Trump has hinted at calls at reinstating Glass-Steagall in the past, but that commentary's died down. I don't see that happening, but obviously something that we want to watch. Republicans themselves have identified 75 energy and environmental rules to repeal. Congress, the immediate move is going to be for Congress to target the Congressional Review Act, which would eliminate the stream protection rules for coal mining and methane gas. Coal and financials are obviously the beneficiaries in any sort of deregulation. But again, this is going to be thrown out or rolled out as riders to legislation. So we're really going to have to keep a close eye on that to see what's being tacked on here. Then another key theme for 2017 is going to be reflation. All eyes will be on inflation with Trump policies, as we've already seen. We've already seen this play really take hold as the idea of infrastructure spending, tax cuts, and less regulation are really heating up the idea of inflation, as reflective in the recent hawkish outlooks from Fed members. This is really going to be led by wage inflation, and with that, we're going to want to keep an eye on what happened in the 1950s. I'm going to do a little bit more research on this myself, but that's the last time we saw a cycle that was led by wage inflation. And the end result, businesses spent a lot more on technology to offset the wage inflation. So, areas of robotics, areas kind of like a Mobileye are going to be really key to watch here. Another area on this reflation play that I'm curious to keep an eye on, and I think one of the most important levels, I know everybody's got their eyes on 20,000 Dow, and it's a great story, but the 2.60% area in the 10-year yield is, for me, the key area. How that reacts will kind of help judge, bond purchasing and, where the idea of the Fed is going. Has the 2.60% priced in the 3 rate hikes that we continue to see the Fed talk about? Do we see bonds getting bought back here if this yield continues to hold into place on the idea that the Trump policies will not go through as cleanly as some hope? So again, that goes back to Congress and a lot of these bills that are, it's going to make for a busy early year to try to get a good hold of what's going on in the markets and what areas are going to work out. And then when we're looking at some of the reflation plays, TIP for tips, that's going to be a hot area to look at. That's already seen a nice little run. USRT for REITs and REM for real estate, and then, of course, GLD for gold. And we've talked about the negative impact on technology with the parts makers for inflation. Does that drive pricing up, too, for some of these consumer inflation or for some of the consumer plays, such as an Apple? Do the parts for Apple iPhones get driven up to a level that you're no longer seeing some of the good deals, or does Apple and Verizon go back and renegotiate some of the deals. So all things that are going to play out from the reflation plays, and something that we're going to be discussing in a lot more. Just real quick, I'm popping through that central bank thing. Here's some of the Trump winners and losers we discussed in the election webinar. So these are going to be areas that you're going to want to watch, we're just going to kind of build off from there. But I just wanted to show that slide. It's actually misplaced here, unfortunately. But that's some of the more domestic looks. Taking a look at some of the global issues that are going to be facing us in 2017. Just wanted to note central banks, obviously, moving away from the only game in town to a lot more dependence on fiscal stimulus. The Fed, obviously, is the highlight of that. We're looking at 3 hikes from the Fed this year, and a lot of the early commentary from members has been suggesting that this will be the case. We've seen it in the past, and they've fallen short of these goals, but the potential for inflation certainly drives up that likelihood. Their comments on fiscal stimulus, we discussed that on the infrastructure page, but so far Yellen and Williams have kind of kicked back against fiscal stimulus, not seeing a need for it, and I'm curious to see if this crosses over all the Fed members, and more importantly, does this end up impacting the independence of the Fed, which has been a hot early topic under the Trump administration, with more auditing looking potentially being passed. A fight back against Trump policies could certainly drive that even further. And there's the Trump appointments. There's 2 Trump appointments that can be made nearly immediately, and one of the key ones is going to be surrounding bank capital. So this is all going to be the hot topics for the Fed in 2017, and this is only scraping the surface. The European Central Bank, of course, their asset program, they just extended it to the end of 2017. But the question is, will pricing pressure force them to tighten? Jean-Claude Trichet, the former ECB president, famously we only have one needle in our compass, and that was towards pricing. And, if we start seeing pricing in the U.S. wash ashore, does that impact the ECB outlook? And, of course, there's the protection of the euro, which we'll get into a little bit further. Bank of Japan, they implemented their new quantitative and qualitative easing with NER policy, which is the pegging the 10% yield to 0%. So far, the last 2 auction sales for the 10-year yield has risen above that 0% threshold. So far they haven't been able to do that, but one has to wonder, they got to be pretty happy about the inflation that's slowly creeping up, and if that pulls back from the monetary policy and allows them to do more fiscal policy. But, the Abenomics and the rollout for this is going to be continued to be watched. The Bank of England, how does Brexit impact them? And, the expected easing policies that they have in place to support the uncertainty, will they expand that? And then, of course, there's the People's Bank of Japan, and how does the bank treat the yuan and the credit threats that it's going to be facing in 2017? So moving past the Trump winners, so we're going to take a look at China real quick here. China, of course, the yuan management is going to be one of the big stories of 2017. We've already seen that early in the year. And, whether or not they're going to tighten credit conditions a little bit further and try to tighten the yuan, or if they're going to look to China do a one-time devaluation like they did in August 2015. It's going to be a hot topic in early 2017 that we're going to need to watch. And with, the trade wars on top of this, it's going to really add to the, potential of some sort of drastic move in the year. We've already seen rates in China on the rise due to the Fed moves, because there's a lot of Chinese companies that have dollar-denominated funding, and it's already tightening the China credit market, as this is a big source for short-term funding. And of course, with China, the trade wars with the U.S., with 20% of Chinese exports going to the U.S., that was $482 billion in 2015, or 10% of the GDP. Talk of the 45% punitive tariff by Trump, while it's been played down, would slow the GDP down by approximately 3%. The current tariff's at 3%, if you're wondering. And some areas to watch here is tech. Currently 75% of mobile phones and 93% of PCs are shipped to the U.S. So there's a lot of play here. Companies with high China revenues, these are going to be good names that you're going to want to keep an eye on. SWKS, QCOM, Micron, which of course, I've been long on for a while and continue to be, and Texas Instruments. And then, of course, Walmart's the play that I'm going to be watching here on the higher costs. And then just another thing to throw on the calendar, the 19th National Congress, which brings in a twice-in-a-decade leadership change, is in November, with 5 of 7 Politburo members expected to change. So this could really change the aspect of how China's approaching relations with the U.S. later in the year. With Europe, we're going to pick things up here a little. The question here is, will they create a deposit banking, which would be good for all European banks, thus the EUFN, which I have a long in, and the single bond market. Will they ever get around to doing that? It's going to be really tough to do with potential fissures coming along the geopolitical scene in Europe. There's potential rise of 3 populist governments, possibly 4, in 3 of the 4 major economies, too, in the area. Moves like this could possibly drive the euro to parity and below if people start getting worried about other countries moving out. We're going to start off with the Dutch elections in March. We want to watch the Freedom Party here to see if they can win or not. The French elections will be in April 2017 and May 2017 as there's a runoff. Right now the favorite is Fillon, who's the conservative, but everybody's keeping an eye on Marine Le Pen and whether or not her party can rise up as well and drive populism even further. And in Germany, we got elections in September and October, which is basically, a watch to see if Merkel can hold on, while the AfD, who's gained inroads in 2016 elections and regional elections, can cut into that. And then, of course, there's Italy, which has some electoral laws that they got to put in place in January, and that could drive elections sooner rather than later under the current caretaker government. Elections are possible here in Q4. Just laying out some other key elections to keep an eye out in 2017. We got the Hong Kong one in March, which will help see which way that country's going to lean, either towards mainland China or the U.S. Iran in June with the nuclear deals on the table. India in June and July with Modi trying to push forward a lot of economic reforms. Argentina in October, which is more regional influence for Latin America, and with Brazil in 2018. China, as we discussed before, with big change expected in the Politburo up top. ZA is going to remain, though. Chile, again, with following Argentina, and also as a copper play. And then looking at the 2018, we got the U.S. midterms, Mexico and Russia all in play. So, a lot of potential geopolitical change over the next 18 months or so. Then taking a look at Brexit, another key topic going forward. Article 50 will be triggered is expected to be triggered at the EU meeting at the end of March, which is March 25th. The Bank of England has already said they expect a Q1 slowdown, but we could see, so far they haven't really been able to prognosticate the economic reactions yet. But once this is set off, this sets off a 2-year negotiating period. Extensions are possible, so keep that in mind. We're going to want to keep an eye on Scotland to see if they look to vote for their own independence. But here's some of the scenarios that we're looking at. We kind of highlight the single market scenario or the Norway option, which would be the best case. This would more or less allow the UK to continue on without having to worry about the immigration issues. But all the talk that we've seen so far has been pointing towards a hard Brexit, which is a WTO and eventual UK-EU FTA deal, which basically means the UK would have to redo trade deals for all the countries involved. The EU would be particularly hard. We just saw Canada take 7 years to do a deal with the EU, and one small province in Belgium nearly offset that. And we're already seeing the UK negotiating party for Brexit just recently pulled out from talks with the EU, and comments from May have suggested difficult battles moving forward. Moving on to emerging markets, this is an area where I kind of like, actually. Obviously, you got the trade protectionism issues, but they kind of appeared to turn a corner in 2016, and despite a lot of potential for them to sell off. Obviously, the stronger dollar is an area of concern for the dollar-denominated debt areas, but again, the trade protection, but it could help some of their exports. And when you look at it compared to the U.S., there's some favorable valuations here, where taking a look at that last bullet point, since July 19th of 2007. Now, this isn't from the March 2009 lows, but just a little bit before the big sell-off. The S&P is up more than 75% above pre-crisis highs. The EFA is still lower by 6%. The EEM is lower by 10%. So emerging markets is an area where I'm going to look at closely. And just another side point, Fitch's 25 negative outlooks out there, 3 positive outlooks, which shows that there is some downside risk. But 82 of the 114 countries are stable. So that's important to note. Now, I'm going to provide a PDF for you guys for the dates, so it's nice and easy for you to print out and hold on at your desk. But the rest of the presentation is just going to kind of be a quick listing of things, so we're just going to scroll through this. But the calendar with key events. All right. And then, here's some of the risks. This is, it's very obvious. I think probably the biggest one is the earnings recession one. Q3 was the first positive we saw in terms of year-over-year earnings growth. Question is whether or not Q4 will, which is expected to, will follow on. That would obviously be a bonus. But if this was to slip back into negative territory, that would really bring into S&P valuations into question a lot. The civil unrest, I'm just throwing that in there. That's always, I suppose, a potential area. Stock price suffers, which kind of goes back to the valuation. Inflation runs a little bit closer, a little faster than the central banks can keep up with. And then, of course, the geopolitical tensions, which we have discussed. Here I'm providing some stock ideas, which I'm going to go off on a little bit more on the website. This is a little tougher forum to really kind of go in to greater detail. But, the end of this site is, or the slideshow presentation is going to be areas where I'm giving you some tickers that I'm going to be following and commenting on the site. If there's any tickers in here that I have not discussed or that you would like to see discussed, obviously fire that off to our Q&A. So that is going to end our presentation here. Definitely want to thank everybody for joining in. We kind of run out of time for Q&A, unfortunately. I do apologize for that. But what I will do is I will be running it on the website and providing feedback on the website. Also going to, provide some PDFs on the stocks in play. We're also going to provide a link to the presentation. So all these materials you will be able to get, as well as a link to the replay on our briefing YouTube page for those of you who missed it or who got on late or who missed any parts of it. But I definitely want to thank you guys for enjoying it. This is only the start of 2017. We're going to continue discussing a lot more of these in greater detail, and also discussing the launch of a podcast that me and event trader Brett Manning are going to run, discussing a lot of the macro. So thank you very much for joining us today, and I look forward to continuing the discussion throughout 2017.